This is the Rocket City Retirement Show with Cris Wallace. Cris loves educating people in person and over the airwaves. Whether it's retirement planning, investing, tax, or legacy, Cris prides himself in helping protect what matters to you. This is the Rocket City Retirement Show.
Hi, I'm Luann Fulmer, and we welcome you to the Rocket City Retirement Show. Of course, I am here with certified financial planner Cris Wallace, and he is president of WG Financial Group. Also joining us from the firm, certified financial planner Richard Constantine. So we have some really good things to talk about today regarding retirement. So you're going to want this number handy, 256-937-2010. That is the way to reach out to Cris, complimentary. Call the number 256-937-2010. Text it if you prefer to get on their calendar. Just text visit to that same number. Remember, we're on Facebook. Just look for WG Financial Group 256. Plan, retire, play. That's our motto. We want to make sure that you do that in retirement. And so today, Richard and Cris are going to give you some really good ideas on how to go about that. WGFinancialGroup.com is our website. And remember, this show is now available on Spotify and Apple Podcasts. Just search for Rocket City Retirement Show. So my gosh, here we go, guys. Welcome to you, both Cris and Richard.
Yeah, welcome to you as well, Luann.
Thank you so much.
Thanks, Luann. It's good to be back.
Aw, good to be with you again. I've been gone, and I know Cris was kind of gone, but not very, right, Cris? Just a little.
I mean, we had that weird midweek holiday, and I am not a fan of a holiday right in the middle of the week. I don't know. It's hard to look at it as a holiday. And I still want to work. And
right.
It's awful because it's the 4th of July and I didn't take off Friday. I just, I work. That's just what I do. And so I'm trying to go to sleep, and you got those crazy 4th of July folks that are just continuing to pop off fireworks. And it happened Friday night. It happened again on Saturday. I even heard a few on Sunday. And I told Jennifer, I basically said, if any of my neighbors start popping fireworks on Sunday night at 10 o'clock, I'm going Clark Griswold, and I'm putting on the robe and whatever. And I'm going outside. I'm going to my neighbor's house and be like, hey, listen, you had a whole week to do this, bro. It's time to shut it down.
So, Cris, I'm glad I did not live next to you growing up. My younger brother's birthday is July 7th.
Oh, boy.
And the only thing that he would ask for his birthday was to go to the fireworks stand. And, since that after 4th of July, everything was half off. And he spent all of his birthday money on purchasing fireworks at half off. And that's when we launched fireworks.
Oh, my gosh. Yes. How fun. How fun. Yeah, good thing you weren't neighbors.
Glad we weren't neighbors.
Yeah. So I got to tell you guys, I bet you had a blast, Richard.
Oh, yeah.
My gosh.
There was
so fun.
Surprisingly, even though both my parents work in the healthcare field, they let us do some things that I don't think I'll let my children do. We were allowed to shoot bottle rockets at each other as long as we had glasses on, and all the above. So,
oh my gosh, pretty lenient. I gotta tell you,
I think the thought process was, since there is that time delay between when a bottle rocket explodes to actually, or from when it hits the ground till it actually explodes, that if we couldn't get out of the way of it, then that was on us. But I'm not.
They thought you were pretty quick then, huh?
I guess so.
They thought you guys were pretty quick. Well, last night I heard one firecracker go off. I was like, what's that about? Who shoots one? But anyway, I was glad, I was glad because, yes, it's definitely over with.
We grew up poor. We just had those little paper things you throw and the snap pops.
The snaps, yeah.
Yeah, that was our fireworks.
That was
There was no fire. It was just a pop. And it was like, oh, this is really cool. These are 50 cents at the store.
Yeah.
And that's pretty much what we grew up on.
Oh, my gosh. Well, anyway, so now here we are, 4th of July is over, and now the back to school ads are going to start coming on television. You would just watch. But speaking of watching, just thinking about what's taken place here lately as far as current events goes, the debate. There's so much talk about the debate. So I wanted to get your any responses from you guys on what's happening with the election.
Yeah, for the most part, I felt like the debate did not cover the topics that they should have been talking about. But one of the things that stuck out to me was when President Biden was asked what he would do to fix Social Security. Mm-hmm. And, Social Security, as we've talked about, is a crucial part of any retirement income plan. One, everyone is eligible for it. And two, it doesn't really matter how much your assets are. It's still great to be receiving a guaranteed stream of income that is also going to be adjusted with inflation. And so what President Biden said that he would do to make sure that Social Security is still solvent when they're projecting it to run out is that and this is something that Chris and I have talked about on the show previously and given our thoughts on, is that he thinks the best way to do it is to increase the Social Security wage cap. So currently, for listeners, right now it's right around $166,000. If you make anything over that, you are no longer contributing into Social Security, whereas President Biden suggested that cap was no longer going to be in effect.
So people who make more money are going to pay into it then?
Correct. I mean, that's what he suggested as an idea to fix it. It's that still has a long way to go to actually it being in effect. Yeah. But that's one of the ways that he suggested it could be fixed.
They won't fix it.
Not you don't think it
solvent.
Will?
Yeah.
Yeah. And with that, even if you take it off, I mean, anyway, I watched the debate. It was not too exciting, right? I mean, it was kind of, in some ways, it's kind of sad. But he says taking off the cap, that's not going to fix it. There's more work to be done there. If the cap comes off, that's fine. It'll make it solvent for a number of years. But there's still a lot of work that needs to be done. I was actually surprised that they even brought it up, to be honest. When that question came up, I was like, oh my gosh, they're going to actually talk about something that matters.
Yeah.
Something that is really, really important that they've been kicking down the road. So just a point of clarification on Social Security. Not calling you out, Richard, but you did call me out the other day, so I got to get you back. Social Security is not available to everybody. You got to work and pay in 40 quarters to be eligible. So it's not just given to you. You got to work and pay in 40 quarters.
Yeah, I should have been more clear. You're correct.
Yeah. I can't remember what it was. A few shows ago, you asked me something about a stock, actually, and
I did. I asked you, and let's see if you remember, Chris.
It's the one that's never split.
Yeah. What is the only? So it is a Magnificent Seven company. So giving you a hint there, but it's only top 20 company regarding the S&P 500 weighting that has never split.
And I don't remember, believe it or not.
It's Facebook-Meta. So
yeah.
Facebook, right?
Yeah. Oh my gosh. Well, anyway,
short-term memory here loss.
Yeah, look, he already forgot.
Yeah.
That's how much he cared. Anyway, that's interesting about Social Security. Gosh, the way I look at it, I think everybody, no matter what they make, should pay into Social Security, but that's just me.
Well, you do pay into it.
But people who make over that amount then don't have to pay as much.
Oh, correct. Yeah, well, the current wage cap, right. The high income earner, when they eclipse that, they essentially get a raise of 6.2% back into their paycheck for the remainder of the year.
Yeah.
But in talking about removing that, or pushing it way up, it will help for sure.
Right.
I mean, we've talked about it a number of times on the show.
Yeah.
But it will not fix it and make it completely solvent. It might be one of the Band-Aid issues there that they might look to do, but there's a lot of other work that has to be done with Social Security.
They got to do something.
They do.
Because they're spending too much money.
Yeah. Well, and the problem too is you don't have a lot of work. You got a ton of people retiring, the baby boomers. And it's a kind of a pay-as-you-go system. So you just don't have enough people paying into the system fast enough to cover the people who are actually retiring and actually collecting benefits. So there's some work to be done there. And like I said before, the party that's in office at the last minute will come up with something at the last minute and they'll be like, hurrah, we saved Social Security. And they'll make a big party out of it. And meanwhile, both parties have been kicking that can down the road for, more than a decade at this point, for decades, really. So anyway, that's my thoughts on that.
Okay. That's your thoughts, both of your thoughts. Thank you for that, though. But let's move on now to the current market situation. Richard, why don't you tell us what's going on here, please?
Yeah, absolutely. So it's actually last week was one of the first weeks this year where all four of the S&P 500, the Dow Jones, the NASDAQ, and the aggregate bond index is actually positive.
What?
So last week, I know it's been a shocker. I mean, but right now we are in a very interest rate sensitive environment. And as interest rates rise, bond prices go down. Whereas when the inverse happens, when interest rates lower, the bond prices are going to go up. And so, we are expecting once they start making rate cuts that this will become a more common theme. We can't promise that, but, we're expecting that to be a more common theme. And, last week it was shown that, the bond market is expecting rate cuts at some point in the future. And so it's kind of the writing on the wall. Once we see the aggregate bond index increase in value, that rate cuts should be coming sooner rather than later.
Yeah. And also a big difference between what we've seen now and what we saw at the tail end of 2023, when there was a significant drop in the Treasury. Now it's more of a believable drop. If you kind of look where the 10 years trading at right now, it's definitely higher than what it was in November. So the market, like you said, to your point, Richard, I think is expecting those rate cuts. The writing's kind of on the wall, but now it's more of a believable number.
Oh, exactly. Yeah. What we saw at the end of last year, like what you just alluded to, was what was out of the norm. What we're seeing now makes more sense about the near term and the long term future. So
yeah, markets tend to overcorrect and people tend to overreact.
Exactly. And that's a reason why, it's important not to make knee jerk reactions with your savings.
Mm-hmm.
Which is exactly what I was going to say and lead into your phone number. Yeah. If you guys want some help and some guidance, if you're worried about things that are happening with the market, or if you're not worried and you want to make some changes to what you are doing, then here's the deal. You can set up a discovery visit with Cris at WG Financial Group. The phone number is 256-937-2010. This visit is complimentary. We always tell you that. Now, another thing you could do if you're a texter, to just text the word visit to 256-937-2010 and get your retirement questions answered. That is why we are here for you. That is why we do this show. Cris and Richard and the team at WG Financial Group want to help ensure that you are on that right path to a successful retirement. Again, WG Financial Group is the website to find out some more information there. So we just thank you so much for joining us. So happy to have you along. This is the Rocket City Retirement Show, and I'm Luann Fulmer. Now, today, we thought it would be maybe a good idea to go over some items on a retirement checklist. And Cris, you and I have talked about this retirement checklist before. Really a good way to prepare for retirement, not only financially, but also mentally. And so, as you're starting to kind of, descend down that retirement mountain, if you want to say it that way, there are some things that Cris and Richard want to make sure that you understand and communicate to you so that you're not really surprised when you retire. Cris, let me ask you this. What are a few things that people should know and expect, but then, no one ever really communicates to them?
Yeah. So first of all, when we think about just retirement in general, I guess when you're working and you're thinking about it, you're mainly focused on the money aspect. It's like, okay, how much am I putting away in my savings plan? When I retire, how much am I going to need? How much do I have saved? Will it last? And it's all about that money. But there's a lot of psychology in retirement. I mean, a lot. And there's a big mental battle that happens when you go to turn off that faucet of income, as we like to say on the show. Now, the reason I bring this up, there's a lot of studies on this, but I've seen it for the last 20 years. I've seen people that just battle with basically not working anymore, and then just, not being able to live life normally from a mental perspective because they're so worried and the emotions are just going crazy inside of them. So when you go to turn off that faucet of income, it's going to be stressful. So that's the first thing that I want to tell people. And then the other thing that's really important here is, and I promise you this is going to happen to most of you. It won't happen to every one of you, but it is going to happen to the vast majority of listeners out there today. The way that you view the stock market and the associated volatility is going to change no matter how much you have for most people. So the way that you're going to view the market's going to change. Think about when you're 20, 30, early 40s, maybe even latter 40s. You're not worried about the volatility. It does not matter at that point. But the minute you get close to retirement, and honestly, the closer you get to retirement, the way that you view the stock market is going to change.
Yeah, Chris, I kind of got a thought off that. And do you think it's because this is when the person who's entering retirement has the highest, nominal value in their account? So, previously when they only had $100,000 in the account, a 20% drop only showed a $20,000 loss. Whereas now that they have $1 million in the account, that same 20% loss now shows a $200,000 drop.
Yeah, it's probably that. You bring up a really good point there as well. Touch back on that in a second. I think a lot of it has to do, people are just worried about running out of money. So they've saved this money, and to your point, they have probably the highest nominal value that they've had their entire life, and they are worried about the stock market, the next big crash, the GFC 2, the Great Financial Crisis number 2, or the Great Depression, number 2 or whatever. So yeah, there's probably a lot of that happening. But you bring up an excellent point, Richard. When you're looking at your money in retirement, this is going off on a little side tangent of what we're talking about. I do think that it's important to look at both percentages and dollars. So to your point there, on 100,000, 20% is $20,000. Now, don't mistake $20,000 for not being a lot of money. It is. To me, $20,000 is a lot of money. But when you look at 20,000 on, or 20% on $1 million, yeah, now you're looking at 200,000, and it just feels different. So the money behavior as well is going to change. So when people retire, they oftentimes will become afraid to spend money because they feel like, well, what if I don't have enough? And this is where planning comes into play. Like having a plan, determining a spending plan, all of that. This is where planning really, really helps, because you're probably going to become afraid to spend money during a time when you actually should. Those are kind of the go-go years. And, when times of volatility start to happen, you're going to become worried again. You're not going to want to spend. You're not going to want to pull out of the portfolio because you don't have a spending plan. You don't know how to take the money out. So the thing that people I see is they start to clam up. They don't do anything. They become afraid. They want to put it under the mattress. And there's going to be a lot of times you're going to be tempted to go to cash. And there's a lot of issues with that because you miss potential upside. True, you might miss some potential downside. But listen, if the smartest mutual fund managers in the world can't time the market, don't think that you're going to be able to do it either. And I'm speaking for myself as well. So you're going to be tempted to run to cash. And again, your money behavior is going to change. Here's the other thing that I've seen that can tend to happen. When you retire or you get near retirement, I see this a lot with federal employees. They're sitting all in the G fund. You have a tendency to maybe you want to become too conservative. And that makes outpacing inflation pretty challenging. And it can also frustrate you, the investor, with making returns that are too little over the long run because you've been too conservative. So then you become frustrated with your long-term returns. So again, these are things that nobody's really going to tell you about because they're more psychological, they're more emotional driven. But believe me, it plays a big role in your retirement. And then some people, and this is what I see this a lot, like I see it a whole lot. You're going to have a tendency to become more negative. And honestly, like as I'm getting older, I always tease Jen, and I said I'm turning into a crotchety old man. And we were walking on the trail the other night, and it was about fireworks, to be honest with you.
Oh no, here we go.
My dog's afraid of them for one.
Yeah.
But anyway, I was saying something about, I can't believe they're shooting fireworks over there in the field because it's been kind of dry, and I just think it's kind of dangerous, right? Yeah. So anyway, I said something about it, and then I looked over at her, and she just looked at me, and she's like, I said, "Don't even say it." I said, "I know exactly what you're thinking, crotchety old man."
Yeah,
yeah. And she said, "You're exactly right." So anyway, so when you retire, not only are your money behavior is going to change, you're going to look at the stock market different. You're probably going to become more negative, and events that happen, that, this next big event, you're going to think it's like the fall of the United States. You're like, the dollar's going away. And, we got all these BRICS nations and they're going to replace the dollar and we're done. We're toast. And so I'll give you an example, and I can't take credit for this. I read it in a book, Morgan Housel. He mentioned this in The Psychology of Retirement, which, by the way, Morgan is a fantastic guy. I had the opportunity a few weeks ago to meet him in person, and just what an awesome experience that was for me. But in his book, The Psychology of Retirement, there was an article in 2008. So great financial crisis, right? We're going through the biggest financial crisis since the Great Depression.
Mm-hmm.
A Russian professor by the name of Igor Panarin published an article on really the fall of the United States.
Huh.
And it was put on the front page of the Wall Street Journal.
Oh my gosh.
At that time.
In 08.
Probably arguably the most prestigious, print that's out there, media print that was out there in 2008. Right. And the article was, if things weren't bad enough, Russian professor predicts the end of the United States. So I did a little bit of research on this. I actually, once I read that in the book, I said, you know what, I'm going to pull the article and just kind of look at it. So here's one of the things that he says. So basically, and I'm looking at a map right now that I actually have up on my computer.
Right.
And I shared it with you guys as well. And so like the West Coast, like Washington, Oregon, California, Nevada, Utah, that's going to fall under the Chinese influence.
What?
And then I guess what would be kind of considered the Central North American Republic, which would be like Montana, North Dakota, Minnesota, Nebraska, Kansas, Missouri.
Kansas?
And several others. Yeah, Kansas. That's going to fall under like Canadian influence. Now, again, this is back in like 2008. This Russian professor is writing all of this. And then the East Coast, all the way down into Tennessee, South Carolina, North Carolina, that was going to join the European Union. And then you've got like Texas and what's known as the Southeast. It's going to be called the Texas Republic, and that's going to be under Mexican influence.
I can't imagine that.
Yeah, fall under Mexico or Mexican influence. And then you've got Hawaii that's going to go to Japan or China, and then Alaska will go to Russia. So the crazy thing is, so this article was published, and people believe this stuff. Like, this is a Russian professor.
Was 16 years ago.
Yeah, but back in 08, it was like the stuff that's out there today. People are reading this going, oh my gosh, the U.S. is toast.
It's going to happen. Yeah.
Exactly. Wow. It's going to happen. So all of that to say, you're going to become more negative. Like, Richard, I know, because we were talking about it earlier. Like, it's just kind of a joke internally. It's like, hey, we got a bunch of negative clients. So we try to be upbeat at the office. We try to remain positive. And because I'm telling you, man, you're going to feel more negative. You're going, the United States is done. You know,
that sounds like my husband, Chris. It does. It sounds like Bobby. That's
crotchety old man.
He's 64.
Chris, imagine how much all of that chart would have blown up if TikTok was as prevalent as it is now.
Yeah.
But there's stuff out there today. Like, I can't think of anything right off the top of my head. I'm not on TikTok because the reason why,
unfortunately, either.
If I were, I would be making all those dances, and I would just be a superstar. And I wouldn't be able to do my financial planning.
Yeah.
Because I'd be doing those TikTok dances out in the parking lot, and I would just blow up. I would go viral.
Yeah, that's what you'd be doing.
That's right. Chris, you can be the client entertainment at our Christmas party.
There you go. Yeah.
That'd be a
you can
big
see those
negative.
moves on a big stage.
Yeah. Oh my gosh. Okay, so that's interesting. I don't know. I'd never seen that before. The divided states instead of the United States.
The divided states, right. It's crazy, Luann. It's just crazy what people can write, publish, and that people believe and really, fall prey to.
Right. Oh my gosh. Okay. So, Richard, let's think of a person or a couple coming up on retirement. Let's say, we're 5 to 7 years out of, from retiring, from leaving our job at this point. Tell us what are some things that pre-retirees should be thinking about during this time as we're kind of going over our retirement checklist.
Yeah, no, absolutely. There is a lot of decisions that need to be made while you're still working about your retirement. And the reason why it's important that you do it while you still have that stream of income coming in via your employment is, there are certain things that you might not expect to need in retirement that you actually do. And so you still have the flexibility to make changes or improve your situation to make the life that you want while you're still working. But once that stream of income turns off, you have what you have, and that's what it is.
Yeah, my parents used to say, you get what you get and you don't pitch a fit.
I like that, actually.
And when you turn off that stream of income, you got what you got. You better hope you got enough.
Let's hope you have more.
Yeah. So just so Richard, like, this is what we do, obviously, for people in the Huntsville area and actually other states as well. But when it comes to say you're 5 to 7 years out, what is one of the first things you think somebody should do, as far as their planning goes? What do you think they should be doing at this point?
I think that they really need to be nailing down the standard of living that they want to have in retirement. Okay. From what I've seen is that 10 year, well, and this is a little bit longer than that 5 to 7 year period, but in about 10 years, you can really make a significant impact in what your future wants to be. There's been clients that I've worked with that, their plan was to work, they're making X dollars now, and they want to, retire at 70 years old, just to say, and then their plan was just to live off of essentially half of their income in retirement, right? So it's a completely different standard of living from what they're living off of now. Whereas since we have had this 10-year window, we can essentially lower their expenses by about 10% in present time, but then they can maintain that 90% of their income throughout retirement. And so they're not going to have that shell-shocked, I can't go down to Rosie's, or I can't go and eat dinner out, right? It's, they can maintain the standard of living that they're used to. And so it's really important that clients have an idea of what they want before retirement, so we can do what is needed to get them to the future asset level to live that standard of living.
So Richard, you're a former college baseball player, and now a golfer. Want to be pro golfer.
Yeah. There was this NFL player that they asked him, like, what do you like to do? And he was like, oh, I like to golf. And they were like, are you any good? And he was like, well,
it's the Buffalo Bills wide receiver.
It is. It's Keon Coleman for the Buffalo Bills.
Yeah.
And he was like, well, I'm not Tiger Woods, but I'm Tiger wannabe or something.
No, he said, I'm Tiger wish he could.
Yeah, wish he could. Yeah, wannabe. Yeah.
Yeah, that guy's really funny. Yeah, but I will say,
I'm Tiger wish he could. Yeah.
Yeah, so I will give you some kudos out here on the air. So Richard played in the golf tournament yesterday, and he wins the long drive competition in the fairway. The difference in the picture he sent me, the difference in the way Richard's ball looked was there's a lot of really short grass around Richard's ball. And if it had been a picture of my ball, it would have had pine straw and pine cones and leaves all around it. And Richard did. So he wins the long drive. So congrats. 318 yards. That was a crush.
Amazing. Crushing it.
So Richard comes back and he tells me he wins a tactical flashlight. And I was like, well, cool. Can I borrow that? Because I'm going to need that flashlight when I go looking in the woods for my ball when I play golf. So anyway, so Richard, spot on with the, trying to identify the lifestyle that you want to live, because the worst thing you want to do is, get to retirement, have to take a major pay cut, because what kind of retirement is that? That's not retirement. You might as well just keep working, because that's called stress when you don't have enough income coming into retirement. So I think identifying that lifestyle there. And so this is the first half of the show. If you're listening to it and this is the first half that you're catching, you can actually hop out to Apple Podcast and Spotify, those platforms, search the Rocket City Retirement Show, and you can listen to the entire episode. So we appreciate everybody listening so far. And again, this is the first half of the show. Hop out to the podcast and hear the whole thing.
Have I saved enough? Will my retirement last? If these are some of the questions you may have, it may be a good time to set up a visit with Cris Wallace. Just text the word visit to 256-937-2010 to schedule a meeting today.
quarters, just 25 cents. That's hardly anything, right? But Cris Wallace and his team at WG Financial see quarters a little differently. A quarter is a lot when it's a quarter of your retirement savings. Now, do you want to pay 25% or more in taxes during your retirement? Well, Cris can create a plan to help address that. Now, if the only time you think about taxes is when you file them, you don't have a tax strategy. But it's not too late to get one with the help from Cris Wallace. So act now to make sure you're not paying a quarter, dime, or even a penny more than you should. Call Cris Wallace and his team at WG Financial at 256-937-2010 to schedule your personalized tax strategy session. A quarter saved is a quarter earned. Call 256-937-2010 now. That's 256-937-2010. Investment advisory services made available through AE Wealth Management, LLC, a registered investment advisor. Firm may not give tax advice.
Navigating uncertain times in the volatile market? Don't make impulsive decisions. WG Financial Group is here to help you plan, retire, play. Call now at 256-937-2010. That's 256-937-2010 for advice you can count on.
You're listening to the Rocket City Retirement Show. So happy to have you along with us today. I'm Lou Ann Fulmer here with Cris Wallace and also Richard Constantine of WG Financial Group. Let's give out this phone number we want you to have for our show, 256-937-2010. Really easy to get a hold of Cris for that complimentary discovery visit. Call that number or just text the word visit to 256-937-2010 and get on their calendar. Any questions you have about retirement, you can meet these friendly guys that you hear on the radio every single week. They would love to guide you and help you have that retirement that you're dreaming of. So, all right, we are talking now about just, 5 years out, 7 years out of retirement. And we're going through a retirement checklist and things that you need to prepare for. So I guess I'll just kind of let you take it from here, Cris, too.
I do want to go back and bring, I got sidetracked with the golf with Richard, but Richard actually was a former college baseball player. He played at Western Kentucky University. And I believe you were first baseman, Richard. Is that right?
I was, yeah. I was too slow to play any other position. But hey, random fact. This is a crazy story, okay? In the Western Kentucky University record book, I led the team in stolen bases in the COVID shortened season.
Wow.
So I am forever immortalized at Western Kentucky as being a fast guy, but that is not the case. It was just because of COVID.
Gosh.
Oh man,
That's a stolen bases.
Hey, COVID has some benefits.
Look
It can make you appear fast when you're really not.
Yeah, I think I had like 2 or 3 on the whole year, but that was still the most on the team. So,
oh my gosh, that's funny.
You speed demon, look out.
Something like that. Yeah.
All right, so let's get back to lifestyle for a second because I keep getting sidetracked. This is really funny though, by the way. But okay, so when we're talking about lifestyle and retirement, identifying that lifestyle. I'm a big proponent of trying to live that lifestyle before you get to retirement. In other words, you want to practice. And I use the analogy, this is well before your time, Richard, but called batting practice. So you want to get in there and you want to be taking cuts in pre-retirement and really trying to live that lifestyle. And again, just taking those practice cuts. If you're a female, we can call it dress rehearsal. We want to do some dress rehearsal before we get to retirement, because once we get there, to your point, you said earlier, Richard, we don't want to, take a big slice in lifestyle because again, that's not retirement. That's not fun. That's again called stress. So I think one of the big things here is determining that lifestyle, like you mentioned, but in doing so, identifying your expenses or needed income. So there are people that budget. Richard, I know you've sat with them. Sometimes they have spreadsheets. They track everything to the penny. And then sometimes it's just easier to use net income. It's like, okay, what are you putting away for savings? What are you putting away in your 401k? What's your net income? And I'm sure you run into both of those types of people before, Richard.
Oh yeah, absolutely. Both have their benefits and both have their cons of being one of those two types of people. But like Cris mentioned, that really is how most people fall into one of the two buckets. For me personally, I am more of the net income. I fall into that category, right? I know what I need to save, and then everything else is what it is. But so yeah, there really is two buckets.
Yeah, and I like that approach as well, to be honest with you. Unless you're just like a data person, you want to track everything in Excel, that's totally fine. But I'm the same way with my own finances myself. So I know that I personally want to be hitting my savings targets. I want to be maxing out my 401k, saving an extra in an after-tax account, maxing out my HSA. And then I know if I do all of that properly and kind of line it up with the number of years that I have left and run it in our, planning software, then I know at a certain age, if I choose to get out, I can get out. The leftover, which is what I think we're calling lifestyle, the net income, then I know I can do things with my family, and I can still have my house payment. I still owe on my house today. I pay a 2.75% interest rate. I'm in not any big hurry to pay that thing off. People say, "Oh, you can't go into retirement with a household." Yeah, household with a house payment. You absolutely can go into retirement with a house payment. Now, I hope to have mine paid off, but I'm not in a super big hurry because of the interest rate. I'd rather invest my money elsewhere and, make sure that, I'm hopefully making a better return there. But then also with some of that leftover money, that's memory money for like the kids. I don't have any grandkids yet, and we've told our kids that we prefer to wait on that. We're not wanting to be grandma and grandpa just yet. But, with that net income, Richard, that's supporting that lifestyle, I'm a big advocate for balance. As long as I'm hitting my other savings targets, it doesn't necessarily mean I have to save every penny that I make, because there is a lifestyle balance there.
Oh, and one of the common messages that I receive from clients, especially older clients, is to, it's to enjoy life while you're still, healthy and young, et cetera. So there is you need to make sure you're saving what you need to save to have the comfort and the tool to live the lifestyle you want in retirement. But it's also good to enjoy life while you can too.
Yeah, there's kind of the way I look at it is there's kind of a go-go years when you're, in your working years too. I mean, it's your kids are young, so you need to be going on vacation and taking them on vacation. And hopefully if, your parents are retired and they want to help you make those memories, maybe if mom and dad are wealthy enough, they're helping fund some of that so you can go do your vacations and stuff while you're not yet in your peak earning years. So in terms of determining your expenses, whether that's budget, whether that's net income, whether that's using the rule of 80%, which is basically creating enough income, 80% of your current salary to live off of retirement, whichever way you choose to do it. We think, any of those ways will work, but it's important to start identifying it. The next thing that I think is really important is identifying sources of income. So once you are retired, where are those sources of income going to come from? And one of the big ones, and Richard, you mentioned this earlier because it came up in the debate, is Social Security.
Oh, exactly right. Social Security, doesn't matter how big of a portfolio balance a client has, that is going to be their backbone guaranteed, income for everyone that has worked. As Chris pointed out earlier.
That's right.
The stay-at-home spouse does not get Social Security potentially, but they'll be able to claim off the working spouse. But but everyone that has worked, at least one of the two spouses will get Social Security, and that therefore it is the backbone. Some companies. Important. Oh, what was that?
Yeah, I was just going to say, to kind of what you said earlier, no matter how much money you have, it's going to be important. And I wholeheartedly believe that you shouldn't just, okay, I've got, let's say $5 million. Okay, well, Social Security doesn't matter. Okay, well, maybe it doesn't technically, but from an efficiency standpoint, it does from a taxation.
Exactly. 100%. And also another sources of income are pensions, whether you are a FERS employee, whether it's a military pension, or whether it's a private pension, such as if you worked for a large company locally or even on a national basis, where those are becoming more and more rare, but they are still out there. Some people want to live off only the dividends that their portfolio is bringing in. There's another route that you can go, such as transitioning some of your assets into an income annuity that's going to pay you a fixed amount over the rest of your life. And finally, really the last avenue for sources of income. Well, really, there's two more left. You can have a rental property, which that takes a special kind of person who wants to be a landlord. I do not want to be a landlord, so that will not be a part of my future income stream. But really, then the last option is to pull off principal from your portfolio.
Or try to do earnings. People seem to think that they're going to roll into retirement and just scrape off earnings to live off of. And I think that's really hard to do, honestly, is to just say, well, I'm just going to take my earnings and preserve my principal. I think it's incredibly hard to do and hard to plan for. But you mentioned something a few seconds ago. You talked about being a landlord. Now, that's just not, for me, that's just not something I want to do. Especially nowadays. And don't get me wrong, there are a ton of successful people that have rental properties. But you said it best. It takes a special person that wants to do that. But there's just been so many things that happen, especially like during COVID, when you have a tenant in the house. And I think they kind of opened up Pandora's box, so to speak, where the tenant is not paying, and it's time to get them out because they're not paying. But, and I get it during COVID, but they had some sort of a law or rule or whatever where you couldn't evict them. Like you couldn't evict them. So at what point, if you're a landlord during the next downturn, let's say a recession, who's to stop them from enacting that again, where you can't evict somebody when things get bad?
Chris, have you ever had an ETF call you on Christmas saying that the heater's out?
Well, I did. I wasn't able to get to the phone, but that happened to me. I used to own a rental property, and back-to-back summers. One was in May. It was like the hottest weekend of the year so far. And then the next one was like the tail end of June the following year. So replacing two different AC units.
Aww.
So
yeah.
Anyway, it's just not something that, I'm not cut out to do that. So anyway, all right. So we're talking about pulling off the portfolio. So kind of on that note, I think another thing that as you prep for retirement, you need to determine how much of your income will be portfolio generated. Now, we're big advocates of trying to optimize your retirement income, but I think trying to figure out how much of the portfolio is going to have to support your retirement is really important as well.
Oh, absolutely. Because as we have seen, especially when we're projecting our clients to live as long as we are, for listeners who are not really aware, typically people who have significant amounts of money, they typically live longer due to the availability of healthcare and just other lifestyle factors that typically happens. So we are projecting our clients to live a long life. And there are stress test levels that come into play when projecting out pulling off the portfolio for a significant period of time. We're going to have our we're going to have our double digit up years, and the market's also going to have some negative years. And clients and everyone are still going to need income even in those negative years. That's why, to Chris's point earlier, it's almost impossible to just say, I'm going to live off earnings only, because there will be years where you have negative earnings.
Right. Especially if you're invested in the market, for sure. So some people, go try to look at the 4% rule, because I don't know, when we look at the 4% rule, that's a widely published rule, but I don't know of anybody who actually really truly uses the rule. So I think it's a good rule of thumb to kind of check to see how you're doing. But I think just determining, how you're going to do that. And that's probably one of the questions I get a lot, Richard, is, how do I generate income? How do I pull income out of my IRA, out of my 401k? I get that question a lot. I know you probably do as well.
Oh, yeah, absolutely. And like you mentioned, Chris, the 4% rule is kind of a good rule of thumb, but that's, in my opinion, that's if you're going in blind and not working with a professional. If you're working with a professional, you can get a lot more granular with your specific situation. Because at the end of the day, everyone's retirement is individualized, and you don't want to just do the cookie cutter. This is what you can do. We want to be very specific with our individual clients.
Yeah, I think some of the cornerstone pieces are probably all the same, right? You're going to have retirement income, you're going to have investments, you're going to have taxes, estate planning, all of that. But when you start getting a lot granular is where things get more customized versus, like you said, cookie cutter. And one of the other things as you get closer to retirement is I do think you have to start taking a look at your investment risk. I think that's important. Everybody's risk is going to be different. Their risk tolerance is going to be different. Their risk capacity is going to be different. But one of the things that's going to happen to you, as I mentioned earlier, that psychological is, should I take less risk? And I think one of the other areas, and Richard, I know we've seen this a lot as of late, is just the fee structure within investments. So in the portfolio that may have sat in the same funds for a decade or even longer in some cases, reviewing that fee structure with those mutual funds, because that's typically what we see out of brokerage houses. Just a basket of mutual funds that somebody's put together. They've got a high expense ratio, but also what we see on the backside of that is high advisory fees as well. And some of the fees that are out there, they're actually published online with the ADVs. You can go look it up, and it is just outrageous. Some of the fees that are being charged. I saw one from a firm the other day was 1.85% annually. 1.85%. That is an absolute absurd figure that somebody's being charged or potentially being charged to manage their investment. So checking out that investment fee structure as well. And then I think one of the big things, and again, this kind of goes back to what I said earlier about people being negative, is planning for a longer than average life expectancy. I know, Richard, when you're building plans, when I'm building plans, we're running people into the early 90s because we have to protect for that. And I think families also have to protect for that. And I think kind of what we were talking about earlier, people being negative. How many times have you heard, I'm not living to 92. There's no way. There's no way I'm making it past 75. I'm sure you've heard that a million times as well.
Oh yeah. I think we're at 1,000,001 now, actually. So
1,000,001. So I think one of the things to think about, all right. So, I was trying to think of how to say this without being too TMI, but it is what it is. So I just had the over 50 inspection done, right? The old tailpipe inspection, right? If I'm being honest. So listen, if you're listening to the show, go get that thing done.
Right.
You need to get it done. The trends are that more and more people are coming down with colon cancer, and you can probably attribute that to, diet, stuff like that. Yeah. There's a lot of factors that cause it. Mm-hmm. But the point of me bringing this up and being vulnerable here is, there are screening mechanisms that are available today that can help you live a longer than average life expectancy. So when we talk about our parents passing away, at earlier ages, they probably, and again, I'm not saying they didn't, I'm just going to say the likelihood of them not going to the doctor and getting their physical, not going to get that over 50 tailpipe inspection, those other screening mechanisms that are available today that weren't available back then are likely some of the reasons that people passed away early. So they did find a couple of things in my inspection, and they came back benign. So it's great. Good. So really, really good news. But had I not gone, because now the age is 45. It used to be 50, but I say older than 50 because now you know what I'm talking about without trying to say the C word, because it's kind of hard to say the C word. Anyway, it's 45. So when I went in to have my physical, my doctor says, "You're late," and I'm like, "Wait a minute, I'm just now 50," and she's like, "Nope, it's 45 now, so you're late." I'm like, "Well, they moved the goalpost. They moved it on me." Yeah, exactly. So again, planning for that longer than average life expectancy, there are a lot more screening mechanisms that are out there today. The other thing that I think is that we have to our advantage is, Richard, both of your parents are doctors. I've actually spoken and met with your mom before and had dinner with her, and there's a lot of information available for health stuff today. So we know that vitamin D is good for you. We know that magnesium is good for you. We know that cardiovascular and weightlifting are good for both men and women from bone density reasons, testosterone reasons, especially for men. All of those things also help you live longer, and it's all available online. Like there's a lot of tons of research that definitely has helped, I think, as well.
Well, hey, Chris, if you need some podcast to listen to, I get inundated with them every day. About different medical reasons or what you need to do.
Yeah, from your mom. Yeah, Richard's going to live till like 150. And he's still going to be hitting a golf drive 300 yards at like 101.
But I can hardly walk today. I'm feeling old.
Oh my gosh, that's so funny. Let me just interject this. My brother-in-law, he ignored his screening and did not go until it was too late. And he passed away 3 years ago. And both his parents lived a long time, but I think it had to do with a lot of barbecue, his diet, and the fact that he kind of ignored the signs. So yeah, you bring up a very good point, Chris. We are all living longer, but we do have to make sure we take care of ourselves and pay attention to what's going on with our lives and our health.
Yeah, we do. And again, get those screening tests done for sure. So the other thing I'll kind of roll into now is that you should be doing as a pre-retirement checklist is you should be thinking about taxes. You should be doing some tax planning, maybe looking at some tax efficient strategies for the future. I know one of the things that we think is advantageous for most people, but is also difficult for some people to kind of swallow the tax pill, if you will, is doing a Roth conversion. We've seen numbers that make sense for a lot of people to be doing that. We can probably make a safe assumption that taxes are probably going to go up in the future. So taking a look at some tax planning is probably a good idea as well.
Are you guys seeing a lot of people using the Roth conversions? Are people wanting to do them?
Yeah. Some,
not all.
Yeah, but not all. But so here's an example for you. So on $100,000 conversion, you're looking, if you're in the 22 bracket, which you will be more than likely on a conversion, $100,000 conversion, at least the 22, you're looking at $22,000 in federal taxes. So when you get, presented with that number, that's what it's going to cost you today to do that conversion, it does cause hesitation with some people. Even though the long-term benefits is probably going to be there for most,
right?
It's definitely something that's harder to swallow.
Mm-hmm. Okay.
Yeah. The other thing that I think we can look at too is, as you just think about tax planning in general, we did a couple shows on taxes here more recently, is the charitable giving aspect. So start thinking about how you're going to give charitable. You should be doing that, well before retirement as well. Gifting appreciated assets is also important, how you're going to do that in terms of giving to charity. So that kind of falls under charitable giving as well. And then we mentioned earlier, like Social Security decisions, that's part of tax planning, believe it or not, because Social Security has a tax advantage to you because that only 85% of it is subject to tax again. So we think that's important. And then also just understanding what the IRMA impacts are. So IRMA is basically the income related monthly adjustment amount. And that is where if your modified adjusted gross income is too high, then your Medicare premiums go up. So really start looking at that tax planning early in retirement. I think that can actually help out as well. And then another pre-retirement thing. Did you have anything you want to say on taxes, Richard?
Yeah, well, Chris, actually today met with a prospective client alone. They're in their early 50s, and right now they have a significant amount of money in only pre-tax vehicles. And right now, all of their after-tax, they don't have much after-tax money saved up. And one of the things that we are going to do is to start saving more in their after-tax accounts. So in the future, we do not go through their IRMA limits so that they can still live the life that they want without having to pay more in Medicare and other issues that come with going through the IRMA limits.
So that's tax planning. Yeah, that's great. Exactly right. Exactly. Social Security strategies is another big one as you're preparing for retirement, and on that checklist is taking a look at, am I going to claim early at 62? We've beat the drum of Social Security forever on the show. Obviously, claiming at 62, you're taking about a 30% haircut. But then the question becomes, do you claim at FRA, which is full retirement age? Do you wait until 70? I think you have to take into account who has the higher of the two Social Securities. And you have to place a lot of emphasis on that particular Social Security because that ends up being that spousal protection from an income standpoint, because we know a husband and wife, if the husband or the wife passes away, it doesn't matter who passes away, that smaller Social Security is going to go away and the higher one is going to be kept. So placing a value and emphasis and strategy on Social Security planning is hugely important. And a few minutes ago, I mentioned, tax planning with Social Security. It's another thing that I think people just often overlook. I've met with people, and we talked about it on one of the previous shows, where you've got somebody that's still working, family still working, and let's just say, for example, the wife has a smaller Social Security, and they just say, okay, at 62, we're just going to claim hers because it's only like $700, and she's going to get her money, and now we can use that as spending money. Well, you're going to subject yourself to higher taxation, because if you're still working and you're drawing W-2 income, you've also got to put the Social Security money or payment on there as well. And so what's going to happen is your income is going to drive up a little bit. So you're going to pay more in federal tax. And then also, because you claimed early at 62, if that was the case, then you've taken a 30% reduction in benefit. So now we've got a 30% reduction in benefit. We've got a little bit more federal tax. And then also we stopped the growth because we claimed at 62. So we've omitted that 5 to 6% growth between 62 and 67. So we've done three things there that, probably wasn't the best decision. I actually think in a case like that, I'm going to use myself as an example. Let's say that I was, so I'm roughly 5 years older, not roughly, I am 5 years older than Jen. So let's just say I'm 67 and I'm still working and I'm drawing a salary and she's 62 and she says, hey, I want to claim Social Security. Well, I would be more inclined to just almost, if she wanted to have quote unquote spending money, I'd almost be inclined just to give her like some money out of my check so that her Social Security could continue to grow and so that it wouldn't increase my taxable income. I think that is what I would be inclined to do. So like on this situation I just mentioned, because I've seen this multiple times where the wife has a small $600-700 Social Security. I almost think it's just better just to give her $600 or $700 and continue to let hers grow, because ultimately she's going to draw more income later on, which is ultimately going to help, the taxable situation. So anyway, the other thing too, as we get close to the end of the show here, is your Medicare decisions are really, really important. I think that you have to understand whether you're a federal employee, do you carry the Blue Cross Blue Shield? Do you suspend it? If you have TRICARE, there's a whole lot of things with Medicare that I think are really, really important. Long-term care insurance, whether or not you should have that. We firmly believe that you should start looking at that in your early to mid 50s, not waiting until 60, which is what a lot of people say. I definitely see that as a big problem. So long-term care is a threat. And again, we say don't wait.
Do you feel like the last 5 to 7 years are very critical for a pre-retiree, Chris?
100%.
Yep.
100% I do, especially when it comes to avoiding a major loss. The last 2 years have been really good. I think it's been kind of euphoric for a lot of people, but I think the last 5 to 7 is super, super critical. I think it also makes sense where interest rates have gone and become attractive to start looking at sectioning off some of your portfolio for guaranteed income, because rates have risen so much. I think that it puts, I think you have to really think about looking at certain income products because they have become very, very attractive. I'll give you a quick example and then we're off to the end of the show. Let's just say you got a couple age 59 today. They've got $250,000 they want to use as income. If they put that $250,000 in an annuity and they deferred it until age 65, so from 59 to 65, they're just deferring it. At 65, they could pull off $28,400. If they were to leave that same $250 invested, they would need that $250 over the next 6 years to turn into $710,000 just to be able to use the 4% rule. So rates are very advantageous right now. I think that they've risen and they've become very attractive for people that are looking for additional guaranteed income. And I think the best time to do that is that 5 to 7 year window and try to match your retirement time horizon. So, Luann, I know that was a lot at the tail end of the show, but that's what we do in the office every single day, is go over these types of numbers to help people understand, what their retirement's going to look like. So appreciate you and Richard being here. I appreciate all the listeners. Hope everybody has an awesome and blessed week. And remember to serve every person in every situation with a servant heart. I'm going to give our number out one more time before we get off the air, 256-937-2010. Call for your discovery session, 256-937-2010.
Investment advisory products and services made available through AE Wealth Management, LLC, a registered investment advisor. Insurance products are offered through the insurance business WG Insurance Services. WG Financial Group is an investment advisory practice that offers products and services through AE Wealth Management, LLC, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by WG Insurance Services are not subject to investment advisory requirements. AEWM and WG Insurance Services are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. WG Financial Group is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by WG Financial Group. This radio show is a paid placement.